Let's move on to discuss insurance requirements. In order for a lender to protect itself against losses, it will require a borrower to obtain certain insurances prior to funding the loan transaction. The most common type of insurance required is hazard or homeowner's insurance. This type of insurance will protect the lender from losses incurred by fire or other destruction of the property that is held as collateral on the mortgage loan. The lender will require an effective date on the policy on or before the loan closing, with a typical minimum renewal date of 1 year from the start date. Coverage should be equivalent to the replacement cost of the improvements upon the property. The idea here is that dirt doesn't burn, and as such, there is no reason to pay for insurance on the land also. Doing so would be requiring your borrower to overinsure the property. Borrowers who fail to pay to keep their policy in place will be in for a big surprise, as lenders are allowed to put force-placed insurance on the home in order to protect their interest. Let's pause for a special note regarding force-placed insurance. The term force-placed insurance means hazard insurance obtained by a servicer on behalf of the owner or assignee of a mortgage loan that insures the property securing such loan. The following insurance does not constitute force-placed insurance under this section. 1. Hazard insurance required by the Flood Disaster Protection Act of 1973. 2. Hazard insurance obtained by a borrower but renewed by the borrower servicer, as is described in section 1024.17K 1, 2, or 5. And finally, hazard insurance obtained by a borrower but renewed by the borrower servicer at its discretion if the borrower agrees. Additionally, a servicer may not assess on a borrower a premium charge or fee related to force-placed insurance unless the servicer has a reasonable basis to believe that the borrower has failed to comply with the mortgage loan's contract's requirements to maintain hazard insurance. In order for force-placed insurance to be charged, the borrower must be notified at least 45 days before the fee is charged. The charge can be placed once the lender has sent 2 notices to the borrower and received no response. If, however, the borrower renews the policy, the lender has 15 days from receipt of evidence of renewal to refund any fees that overlap. Now let's get back to the policy. The policy must list the following items to meet the lender's requirements. 1. The borrower's name and loan number. 2. The street address of the subject property. 3. The mortgage lender listed as loss payee. And finally, the amount of coverage. The reason the mortgage lender is noted as loss payee, known as the mortgagee clause, is to protect the mortgagee's interest in the case of a catastrophic loss. In the case of a loss to the insured and mortgaged property, the insurance company payment is paid to both the mortgager, which is the borrower, and the mortgagee, which we know is the lender. This permits the lender to control the insurance proceeds along with the borrower to make certain the improvements are actually reconstructed. The lender may also require flood insurance if the subject property resides in a flood zone, as determined by the flood maps provided by FEMA, which is the Federal Emergency Management Agency. Each lender must complete a flood hazard determination form and must notify the borrower that she or he resides in a flood zone that requires flood insurance.